us. We're Whitman College, and today we're going to be presenting our analysis on Red Lion Hotels Corporation. We issue a sell recommendation based on a number of factors, including Red Lion's difficulty in retaining franchisees, the highly competitive nature of the hospitality industry, Red Line's difficulty regaining revenue after selling its own hotels, and an overvaluation we calculated from our DCF analysis. We predict a target price of $8.50, representing a 16% downside from the February 6th price of $10.15. Red Lion is traded on the New York Stock Exchange, is part of the consumer cyclical sector, and is part of the hospitality industry. Here you can see Red Lion's performance over the past 15 years compared to the NASDAQ, Red Lion in blue, NASDAQ in red, and it has significantly underperformed, while other hotel companies such as Choice and the Marriott have done very well.
Outlining Red Lion's franchise model, we can see that there are 6 ways in which they're trying to achieve growth, 2 of which I will be mentioning. 1, completing their brand stratification, and 2, implementing new technology. Red Lion is doing this by developing their own brands and acquiring other brands, as well as implementing RevPAC. As we can see here, there are 13 logos presented, 3 of which that Red Lion owns, and 10 of which were acquired from the Vantage acquisition in 2016. Looking at the properties that Red Lion owns, they are predominantly in the Pacific Northwest, but are working to increase their presence nationwide. Taking a closer look into management, we can see that all of these executives have experience in the hotel industry as well as in franchising. Paul Sacco, the Chief Development Officer, has experience with franchising and leads and directly oversees the franchising operations for Red Lion Hotels upscale brands.
Here we have a reporter's analysis that we did. The threat of new entrants is high because the barriers to entry for starting any hotel are low. The bargaining power of customers is also a significant threat because online travel sites allow consumers to easily view the prices of hotels simultaneously, allowing them to choose the cheaper option. The threat of substitutes is moderate, as I'll explain later in a study. Airbnb threatens to replace a large chunk of the hotel industry's business. And the bargaining power of suppliers is also moderate because other hotels will be trying to compete with Red Lion for getting the franchisees, so Red Lion has to maintain competitive rates. Some demand drivers in the industry include real consumer spending, and although spending is on the rise, as this graph indicates, the spending on services as a proportion has remained relatively the same throughout the years, between 60 and 70%. Rising oil prices can also threaten the hotel industry because rising oil prices mean higher airfare, higher gas, fewer people traveling, fewer people staying at Red Lion hotels. Finally, corporate travel, which is a significant and reliable chunk of the hotel industry's business, is one of the first things to be cut in times of economic downturn. As this graph indicates, after the 2008 recession, corporate spending was down almost $30 million, and it did not return to pre-recession numbers until 2017.
Moving on to our financial analysis of Red Lion, overall, looking at efficiency, our Red Lion's return on assets has consistently been lower than the industry standard. In 2014, with their move to the asset-light model, the return on assets was 1.06% in comparison to about 3% in the industry average and industry peers. However, in 2015, they dropped to a negative return on assets percentage of about negative 4.4%. However, they did not increase their return on assets at the same rate as which the industry did in this same period of time, as we would expect them to with their move into this asset-light model. In addition, looking at their marginal analysis, almost all of the metrics that we looked at were, in this sense, for their financial analysis in 2016, were negative or much, much lower than their comparables in their industry standards. Looking at their SG&A margin in specific, compared to about 6.6% compared to the 28.9% the industry standard has in the industry, which we expect to be much larger, seeing as they're moving to this asset-light model. In addition, all 6 being much lower than their industry standards, the last 2, specifically net income margin, was about negative 3% in comparison to their industry standards of about 3%, which speaks to us that they're significantly inefficient as a whole. Moving on to their margins and profitability, Red Lion, up for return on capital and return on equity, have significantly underperformed the industry as a whole and their industry peers. In 2014, with their move into this model, their return on capital was about 1.2%. However, in 2016, with their acquisition of Vantage Capital or Vantage Hospitality, they moved to higher than the industry average, which would be expected. However, they did not maintain this growth in their return on capital, as in 2017, it dropped back to about that same level before at 1.5%, which we would expect them to sit at that same level with their movement to this asset-light model advantage acquisition. Moving on to their return on equity, Redline was about 2% in 2014 and maintained this gap between their industry peers of about 5% within the same time period, as they moved to about -3% compared to their industry peers at 7%, which speaks to us that they are not profitable and continue to maintain this poor return on equity and poor profitability as a whole. And for these reasons, in the financial sector, we point to a sell for Redline.
For our evaluation, we decided to run a discounted cash flow along with projecting an enterprise multiple for Redline Hotel. So based on the fact that Redline Hotel has had a tough time keeping franchises, that's shown in the Vantage acquisition along with many other things, we can see we decided to use percent growth of revenue franchise hotel room. And this allowed us to more accurately show Redline Hotel's move to a franchise-oriented, asset-light business model. We then determined the net present value of the franchise operations and added the cash and auxiliary assets along with the expected value that will come from their sale of their owned hotels after paying off their debt. This led to a terminal value of $68.86 million, as you can see, year zero being 2016 here. And when we add these all together, we get a projected franchise value of about $200.95 million. This is a significant decrease from the current market capitalization and shows a downside of 16.2% and a target price of $8.50, which is lower than the current price now. Just to show the projected multiple, I want to give you a baseline of competitors. So you can see right here, Marriott is at 21.04, Hilton at 14.01, and Choice Hotels International at 17.07. I projected an enterprise multiple of 30.6. This was based off of the franchise value that I calculated in the discount cash flow, and also showing that the EBITDA value will decrease significantly based off of their asset-light, franchise-oriented business model. So we expect a 210% increase from the current price.
Here we've outlined some of the main risks facing Redline. The joint employer doctrine was recently redefined by the Trump administration's labor secretary so that franchisors could not be held liable for workplace violations by the franchisees. This should still be monitored, though, because this can change from administration to administration. Additionally, problems with hotel liquidity could severely impact Redline's planned growth, but CBRE Group is one of the world's premier real estate services companies in the world, and we don't see any problems with that. Labor costs, as this graph indicates, continue to be a rising proportion of the hospitality industry's operating expenses, coupled with growing momentum for a $15 minimum wage and the hospitality industry having one of the highest turnover rates of any industry. They're going to be spending more money not only replacing employees, but incentivizing current ones to stay aboard. Also, there are 1.3 million hospitality workers in the US without legal working authorization, and a crackdown on immigration, as signaled by the Trump administration, would cause a serious labor loss. The sharing economy remains a significant threat to the hospitality industry. Airbnb has over 4 million listings, which are more than the top 5 hotel companies combined. And as this study by Ryerson University points out, 61% of people who use Airbnb use it as a substitute for budget or mid-scale hotels, which is a significant portion of Redline's brands. In conclusion, despite Redline's diverse brand stratification and opportunities for growth after selling its hotels, that does not justify a buy due to Redline's few discernible competitive advantages, a highly competitive hotel industry, low brand recognition, and an overvaluation that we calculated from our DCF analysis. We issue a sell recommendation. Thank you. Are there any questions?
Wow, very bold. I appreciate that. What's wrong with Redline? I mean, if back to your slide that looked at return on equity trailing, and this is after the new management team and after the big push in the asset light program. So I'm assuming that the comp base there is also, or perhaps is not asset light. So they should be exceeding, return on equity based on that asset light program. So I guess the crux of my question is, what is this management team and this company doing wrong? What's the problem here?
We don't necessarily think that this asset-light model is the best option. Before they moved to this, it was about 85% of their revenue was coming from the company-owned hotels, which they're moving to sell about 11 of those 14. So we don't necessarily think that's the best option for them or the best financially for them to maintain that growth.
I think the other thing we'd like to mention quickly is the fact that franchising hotels is pretty cheap for a lot of major companies. And so not necessarily they're doing anything wrong, but the fact that for them specifically, they have bigger competitors that could also do just as much franchising and have a competitive advantage over Redline.
Right. So, in that regard, have you seen, or did you see an increased amount of competition because everyone wants to pursue this just branded asset light, dispose of the assets, create a liquidity event, as it were? So is that resulting in lower franchise fees and royalties as a result of more, competitors taking a similar tack?
Yeah, as more companies, like I said, the barriers to entry in this industry are pretty low, and there's already hotel companies that are much bigger than Red Lion, and many of them are also pursuing more franchising. And so when they are pursuing this, they're going to be offering more competitive rates, and they're going to try to poach some of Red Lion's franchisees. The contract for franchisees aren't very long, usually like a couple of years. So Red Lion will have to combat that by offering even more competitive rates, which will erode their profit margins over time.
Very good. Okay.
You had a slide about showed revenue growth per franchise hotel. I didn't see a forward-looking expected growth rate.
Yeah, so this definitely is. Sorry, finish your question.
So what do you forecast as far as their revenue growth for franchise business?
Yeah, so this definitely is a conservative estimate. There's no doubt about that. The main assumption that we were making was the fact that Red Lion has had a tough time keeping their franchises, and so we decided to use a similar rate based on their past trends. We do understand that after selling their own hotels, they will have some free cash to invest in new franchises. But again, our assumption is that they haven't done a very good job keeping their franchises until now. So we decided to go with a more conservative estimate.
What is that rate?
So if
2.77, is that what?
2.77 is the average right on the end.
I know that's backward looking. That's your forward expectation. Is that too?
That is our forward expectation. Again, to keep a conservative estimate. Yes.
Okay. And so, what is that your total revenue growth rate expected for the company, or just the franchise?
Just the franchise. Again, they're planning on selling almost all of their own properties. I think it is about 11 out of 14 in the next few years. They just had it go public that I think 5 are on the market right now, and it looks like they'll be overvalued. They're not overvalued on the market, but they're going to get more returns than they expected, which is good. But yes.
And are you expecting any growth through purchase acquisitions?
So again, franchising is pretty cheap, and so there could be some growth. There's no doubt about that, based off the free cash that they'll be getting from selling their own hotels. But I mean, you look at, that's what happened with the Vantage acquisition. They paid about $25 million for over 1,200 hotels, or approximately 1,200 hotels. But again, I do think that based on the fact that they haven't been able to keep many of those, it is something to keep in mind. So again, we decided to use the more conservative estimate just to be.
One last question on the franchisees. What do you know what they're paying? Each franchisee on average is paying Red Lion.
I believe it's about 3.5% for marketing and advertising, and then it's about it's between 3 and 6% for the off revenue for the overall services.
Do you know what that dollar amount is on average? Thank you.
I applaud you guys' courage to put a sell recommendation on, and I think it's actually a pretty sensible recommendation. The risk that I would have if I were to short or to not own it is that I believe that a lot of these assets were acquired over the last 50, 60 years. Do you think that there's potential risk that the hotels that they're selling could be worth meaningfully more than management has even estimated as a potential risk to your sell recommendation?
Just to clarify, you're asking if the hotels would be worth more than the
Yeah, the
165,
hotels that they're
165.
selling because they've been acquired back in the 60s, 70s, and 80s, that maybe they're even underestimating what the true value of those hotels are.
That could be possible. One of the things they're doing with the cash that they bring in from those owned hotels is paying off a lot of their debt. So even if it is, even if it is a few million more than what they're predicting now, there's still about 1/3 of that is still going to go to paying off their debt. So that is still about 2/3, maybe 100 million, 110 million for their franchising expansion.
And then a follow-up in terms of, I understand, I don't have a crystal ball any more than you guys do, but in terms of your ROA assumptions, that you think that there's a possibility when they sell those assets that they will have scale to the franchise operating model, where then obviously you're lowering your assets because you're selling your assets, that ROA and ROE would go up dramatically over the next couple of years, and the market will maybe reward that?
You're essentially asking if we think that the return on assets would increase through their sales of their. We don't necessarily think so, because at the same time, when they're, in order to pay off those assets, they still incur about $100 million of debt on that. And so not necessarily, I mean, they're still trailing about 6% in return on assets compared to their industry peers, which is a considerable amount. And even when they were looking at the company-owned hotels in about 2013, they were still at about 3% less than the rest of the industry peers. So, no.
Rich,
Yeah, the asset sale program, how many hotels have been sold and proceeds, and then how many are expected to be sold, and what would your expected proceeds be from those?
So they're expected to sell 13 of the 14 hotels for about $114 million, ranging from 114 to 130, depending on how much. And then they've sold, I believe within the last month, they've sold 5 to be sold soon.
And as in the slide with if you go to the slide. Is this map talked about? So the ones in bold are the ones they're selling, but they are keeping the hotels on the East Coast for now, which they can do a couple of things with. One, that extends their brand further, and also they can experiment with those hotels. They've been trying out the Hotel RL, and they can kind of use that as their proof of product.
Okay, so they've sold 13 of 14 you mentioned, or
They're
planning
planning to sell 11 of 14.
11 of 14, okay. And they have commitments on 5 of those?
As far as they're concerned.
Okay. And the use of proceeds, what is management planning to do with the?
Yeah, so they're trying to pay off some of their debt, which is about 60 million. So that would be about around a third of the money they make from that. And the rest, they are trying to simply expand their franchising, their franchise business model. So that's acquiring more properties, either big companies like they did with Vantage, or other hotels that they think they can absorb into their brand.
Right. Management ownership and insider buying activity. Have you seen much of that? Can you just touch on that?
I believe most of the Red Lion shares are owned by institutions. Two of the biggest ones are Columbia and one more that I can't. It's mostly held by institutions.
I think there's a company like in Asia that has a large part of their share. So I think that's like the leading company. And then, as my colleague said, also Columbia.
Thank you.
Thank you.
Thanks, guys.
Thank you.
Good job, you guys.